Have you ever noticed that headlines do more to terrify than clarify? Higher rates send real estate values plummeting. Household debt soars to the highest level in 15 years. Homeowners lose $1.5 trillion as home prices drop. Hi, my name is Wade Perry of the Perry Properties Group of Lux, Denver, and welcome to How's the Market in January 23. After hearing those headlines, one might think we were headed for a disaster like we had 15 years ago. In the next few minutes, I will share with you why our housing market is healthier than it has been in many, many years. Last July, we provided a brief video with great content and context on the market. I would urge you to watch it now as it gives an excellent primer for this video. You can find it on the How's the Market page of the Perry Properties Group website. During the recent past, it was nearly impossible to not be aware of the robust Denver housing market. Fueled by artificially low mortgage rates and very low supply of homes available for sale, our local market experienced double-digit appreciation in many years. During the pandemic, rates went even lower and supply was even thinner, which took our market from robust to supersonic. And for homeowners and sellers, this was Christmas every day and New Year's Eve every night. For buyers, well, this was kind of a nightmare. In short, this was unhealthy and unsustainable. Let's talk about mortgage rates. Yes, mortgage rates have risen dramatically. The 30-year fixed rate now sits at 6.3%, roughly double from last January. This has led many buyers to sit on the sidelines thinking it's a bad time to buy. By slowing demand with higher rates, we have now seen homes take a bit longer to sell, and buyers are no longer paying tens and even hundreds of thousands of dollars over list price like they were during the past couple of years. The end result is a much healthier market with buyers having more homes to choose from and more time to evaluate them. And while some buyers might feel a mortgage rate north of 6% is too high, there will be an opportunity to refinance to a lower rate in the near future. Let's talk about recession. Many economists and journalists have been talking about an inevitable recession on the horizon. The media talks about recessions as if they were the Armageddon for housing. At its core, a recession is defined as a temporary economic decline. This is a normal and healthy phase in the economic cycle. If the economy was allowed to keep running at red-hot levels, the eventual result would be a crash or even depression. By having a mild recession every once in a while, we are able to let a little air out of the balloon so it does not rise too far too fast. And once the recession has shown the economy to have cooled off sufficiently, the Fed will need to cut interest rates to stimulate the economy again. In fact, in 5 of the 6 recessions that we've had since 1970, mortgage rates went down and home prices went up. So clearly, a recession does not spell Armageddon for housing the way journalists would like you to believe. Let's talk about prices dropping due to a foreclosure wave. While on the surface this seems to be a logical assumption, the housing data does not support this. In 2007, when we saw the last wave of foreclosures, there were 2 million households in foreclosure. Through the first 3 quarters of 22, there were only 88,000, a decline of 96%. This can be explained by the fact that in the last housing crisis, the unemployment rate was over 10%. Today, it is just 3.5%. And 92% of all mortgages are lower than 5%. Add in the fact that the level of equity or profit in U.S. households is now over $10 trillion versus less than $3 in the last crisis, and it is clear we will not have a foreclosure wave. Clearly, avoiding a foreclosure wave puts us in a much healthier housing market. So what does all this mean for home prices? After finishing 22 with prices up 4% in the greater Denver area, we believe home prices in our market will remain flat to slightly up in 23. A common data point used in the industry is known as months of inventory. A balanced market where neither the buyer nor the seller has the advantage is when there are 6 months of inventory. In the craziest months of the market run-up, we experienced a low of 0.6. Today, that number is 1.5. So a reasonable shift towards a more balanced market is an important step towards a healthier market. So what does this mean for buyers? After several extremely challenging years, buyers have their best opportunity to buy. Today, there are roughly twice as many homes available for sale in our market than there were a year ago, and the average days on market is 4 times longer. This means that as a buyer, you have more homes to choose from and you have more time to evaluate your choices. This leads to making better and more confident decisions. If you are considering buying, 2023 will be a great time to buy. After what we believe will be a flat to slightly up year in home prices, we believe home prices will resume a historically normal appreciation in the mid-single digits. This means that now is the time to meet with your trusted mortgage advisor to establish your own home buying budget. Even though rates are higher than a year ago, I have seen numerous examples of how a buyer would be better off buying today than they would have been back when rates were lower. Back in the first quarter of 22, buyers were paying 5, 10, 20% or more above the list price, and the 3% rate did not make paying over list feel so bad. Fast forward to today, buyers have been able to buy at prices well below list price. And even though today's mortgage rate is in the low 6s, by buying below list price, there is little difference in the monthly payment. Here's the best part. In the next couple of years, today's buyer will be able to refinance to a lower rate. Now, if you're considering selling, you're in luck. Even though the market has shifted towards a more balanced market, we are still in a seller's market. And while some potential sellers might not want to sell and give up their really low rate mortgage, this is a great time to sell if you're thinking about downsizing. This past fall, we helped several homeowners who had very low mortgage balances and low rates. They had lived in the property for many years and are now empty nesters, no longer needing all that square footage, extra bedrooms, and large yard to maintain. Just as an example, the strategy was to sell a property worth, let's say, $1.5 million with only $300,000 left on the mortgage. They sold and then bought their next home, a lower maintenance home, for $1 million. They now have no mortgage and $200,000 in the bank to enjoy their empty nesting years. In summary, we are moving towards a much healthier housing market. Whether you are thinking about buying or selling, or have general questions about our market like which home improvements are worth your effort, we're just a phone call away. And if you know someone whom you feel would benefit from this commentary, please feel free to share it with them. This is Wade Perry of the Perry Properties Group of Lux Denver, where we are working with neighbors and creating community. Thanks for watching.